Welcome to Ask an Advisor, where we here at Team Clark go deeper on all things investing, saving for your future, retirement, happy retirements.
I like a happy retirement.
And today, mortgages as well. I'm Christa DiBiase here with Wes Moss.
Wes Moss.
And
the highly controversial subject.
Yeah, the 50-year mortgage.
Whoa.
And I definitely have strong feelings about it. I'll say that. And I will express them. We can talk
you were
about
throwing
that a
things
bit.
at me before we got on air.
No, I wasn't. But I do have strong feelings, probably because I've worked with Clark for so very long. And I'd also like to definitely pose some questions to you from our listeners and viewers. If you want to see the podcast, you can go to youtube.com/Clark. And of course, you can listen wherever you are and share and review and rate the podcast. We really appreciate it. And if you have a question for Wes or Clark, go to clark.com/ask.
All right. So where do we start? You want to start with the 50-year mortgage?
I don't. I will mention later on, you're going to give us the key to a winning 401k as well.
I wonder what that key is.
Yeah. So we are going to start with the 50-year mortgage. You and I may agree. I don't know. So let's.
I think so right out of the gate here, there's been a lot of, this is a hot financial topic. Mm-hmm. We brought it up on a radio show that I was on earlier this week. Everybody on the show was going nuts about it. This is the worst thing ever. There's op-eds in the Wall Street Journal that are all about how it's a gimmick and it's terrible. There's memes out there of other financial hosts who are catatonic, having meltdowns about it. And I get that because it really is a gimmick in a lot of ways. I do have one positive thing that it actually could be good, which I know nobody wants to hear. But the reality here, and this in 2025, I think a lot of us have heard about the K-shaped economy. Mm-hmm. The K economy is that one leg of our population is doing really well, and another leg of the population is the part of the K it's headed down and it's not doing well. And that you've seen this in multiple charts. If you look at consumer sentiment, I saw a chart yesterday. Consumer sentiment for people with 401k balances is pretty good. Consumer sentiment for folks who don't have 401ks, not good. Consumer sentiment for people who own houses, good. Consumer sentiment people who don't have a home, they don't own a home, down. So this year, and this has really always been the case, but it's exacerbated even more because we've had now 3 good years of stock market returns. We've had appreciation, though much slower when it comes to home prices and real estate. If you've been an owner of investments, whether it's equity in a home or stocks, you are feeling better today than you were last year and probably 3 years ago, and you've built more wealth, and that wealth effect makes your sentiment higher. And we've seen an even bigger divergence in that in 2025. Ownership has proven out to be financial stability for folks. So the whole key to starting to build wealth is getting started in the game. We'll talk about this when it comes to the 401k. And we also know that the median first-time home buying age just hit an all-time high. It's now 40. In the 1980s, it was in your 20s. And then it drifted a little higher in the 90s and a little higher in the 2000s. But traditionally, if you go back to the 1980s, a lot of folks listening probably bought their first home in their 20s or early 30s. Mm-hmm. And they were able to start building equity in a slowly but steadily appreciating home market. And not only do you get home appreciation if you're staying in a home for a longer period of time, call it 5 years, 7 years, 10 years, you are getting the leverage of the homeowner. You're getting an asset, let's say you're paying a small amount per month because you borrowed, and you get the whole asset appreciating. It's called leverage. That's why there's so many wealthy real estate folks, is they use leverage. They borrow, they get to buy a giant asset, and the whole asset, if it goes up, if it appreciates, it's appreciation on this massive amount of money without you putting cash down for the whole amount. It's called leverage. And that's how real estate folks have made so much money over the years in an American economy that has pretty much had real estate go up, except for the great financial crisis when we saw home prices go down dramatically. Now, there were places and there were pockets that were hit really hard, and collectively, almost every home lost value in the United States, but then that has since recovered as well. So you can see where I'm going on this is that the sooner we can get started on home equity, the better. And if a 50-year mortgage allows, let's say, out of 10 people on the margin, one extra person to be able to start their home equity journey earlier, then that's the one thing I can say that the 50-year mortgage could be helpful with. So in concept, it really could be good because it's getting more people on the upper part of that K, Christa. The problem with it is that it really doesn't save that much money at all. And if you run I've run a bunch of different scenarios. A $415,000 mortgage, that's the median home price today in America, 20% down, 30-year versus a 50-year. Now, in fairness, if you had the exact same rate you're going to save anywhere from, on an average home price in America, it could be $150, it could be almost $250 a month. So it's not nothing. But if you were to assume that the 50-year would probably be a little bit of a higher rate than a 30,
0.5% or
quarter percent, half a percent, then you get the numbers down to more like $150 a month savings, which is not, again, still not nothing, but it's just not that significant.
Yeah, but the difference in the principal you're paying down over time, like if you suddenly have to move because you have a job change or something in 2 years or 5 years, I mean, that you've paid down so much less in principal, then, that's to me the huge issue is you could get stuck. Like, yes, being a homeowner, I am one. It's been great over the last few years, but there have been years we've seen where it's been terrible. And so if the value of your home goes down, you could really get caught, I think, with this. On
$400,000, the payment is I'll round it here, is about $2,500 a month on the regular good old fashioned 30-year fixed, and it's about $2,300 on the 50-year. So it's $150 to $200 less expensive. Is that really going to make a difference whether you buy a home or continue renting? I don't know. Maybe for some people it does, but for the vast majority, I just don't know if the numbers are big enough of a difference to really get people into the market, which it's really aimed to do. Right. Now, as interest rates go up and they've come down, they're still in the 6.25% range. But if we had even higher interest rates in the 7.5% range, we go back a year or two when we were in the 7 range, the amortization of that longer mortgage does help a little bit more. But when you have lower interest rates, it doesn't really move the meter all that much. And to your point again, if I'm looking at simple numbers here, a $400,000 loan if I did this over 5 years, you've paid down $27,000 on a 30-year. On a 5 years into a 50, you've only paid down $11,000.
Yeah.
So the reason people are having meltdowns about how terrible this is that one, the payment doesn't help all that much, but it does some. I want to at least acknowledge that. And the principal pay down, which Christa makes, that's a really important point, it's very different as well. Where it could work would just only be in a situation where you're in a rising real estate market and you build home equity over that first 5-year period, and that could be significant. So I just want to at least acknowledge that. I'm not having a meltdown about it because the other thing, Chris, is that you don't have to stick to the amortization schedule. You can pay it down sooner.
Right, you can. But I'd also say
you may only live in that house for 5 to 7 years, maybe longer.
I mean, I would also say though, like if you're saving $150 a month, are we really saving that, putting that aside? That would be, it'd be, what would that be? $1,800 a year in savings. Are you really saving that? And homeownership's expensive. There are so many costs associated with it, and things break, and just all sorts of other factors too that, I don't know. I just think, I know it's always been the American dream, but sometimes like it can be the American nightmare if you're in a bad situation,
Can't argue with that.
Okay, let's go to questions. Brandon in Tennessee. Brandon says, this question's for Wes. In multiple episodes, you keep referring to weighted investing to avoid being overexposed to the tech sector. Can you please recommend which specific mutual funds or ETFs provide equal weighted investing? I'm currently invested 80% in Fidelity Total U.S. Market and 20% in Fidelity International.
So, Brandon, I'm glad you brought this up because there is some confusion here. We're talking about the percentage exposure. When I say weighting or market cap weighted or equal weighted, it really goes back to how much influence any one stock has. And it is it's a very important, and Clark and I talked about this a couple of weeks ago, for people to understand that if you're in And the majority of assets are in traditional market cap weighted indices. The S&P 500, I don't know how many different index funds there are for the S&P, but they for the most part are market cap weighted, meaning that the top 10 companies are really taking up about 40% of the influence. It's hard to even fathom that. As you have 500 companies, but 10 of them, because they're so big and relative to all the other 490 companies, they have an outsized influence on how the overall index does, i.e. your investment. And the worry is that the biggest companies, for the most part, are really trading well because of the same exact theme. It's tech and it's AI tech. So we find ourselves in an environment where there's a lot of emphasis on that one theme, and if that goes wrong, people will get burned, or they're going to have to deal with these temporary losses. So the answer to that, it would be, how do I find an index that still gives me exposure to the S&P 500 that has equal weights for all 500? It's a very different formula. If you do the math, 1 divided by 500, it's about 0.2. So if you had 100 stocks, every stock would have 1%, and they'd all have equal 1% influence on how it does. An equal weighted ETF with 100 stocks. There's an equal weighted Dow, which would give the same weight to all 30 stocks. An equal weighted S&P 500 fund would give about 0.2% to each one, to all 500. Now, again, I can't recommend or go out and say you should go buy this ETF or that ETF, but here's some examples. RSP is the Invesco S&P 500 equal weight ETF, and that does the job. It is giving you an equal weighting of each S&P 500. There's a NASDAQ version of it. There's the equal weighted NASDAQ ETF. There's also an equal sector weighted ETF. Because if you think about this, there are more technology companies just by number in the S&P 500 than a lot of the other sectors. So even if you're equally weighting them, you're still getting a high percentage of technology. So that's when you may want to look at an equal sector weight where utilities, financials, banks, energy, and tech have the same proportion. The other thing I think you could do, Brandon, is that there are ETFs for sectors, and that is another way for you to try to equalize your overall portfolio by owning a similar percentage of each sector, and it's another way to diversify.
Okay, this one is from Jamie in Nevada. Dear Wes, if you do not anticipate needing Social Security to pay monthly expenses, what do you think about collecting it early at 62 and investing it, for example, in a target date fund 10 years out? I retired in my mid-50s with a COLA-adjusted public retiree pension that covers my monthly living expenses. I'll turn 62 in a few years and will only have a mortgage that is being paid down early. The original plan was to wait until full retirement age at 70, but I'm wondering if there's any potential upside to collecting early and investing instead.
Dear Jamie. I love hearing dear.
I know.
I usually say
when Clark writes me an email, a lot of times he'll say dear
Christa.
He says dear it's. He calls me it's, which is funny.
What is that from?
Because I use it's
ITS?
Christa. Yeah, I use it's Christa as my email. Yeah.
Does everybody know that? I don't know if we want to give that away. Okay. Here's the thought around this, Jamie, is that you've got to be careful. For most people asking this question, you're in your let's call it 62, and you can take social, you've got to be careful about your other income, meaning that if you have a certain amount of income, it would erode your Social Security payment over a certain amount, over about, call it what, 23,400. So for every $2 above that, you would lose $1 in Social Security. So you're going to be careful about, and you have income. The good news for you, Jamie, is that pension income and passive income doesn't count towards that. So you can have rental income, you can have dividends and capital gains, you can have withdrawals from retirement accounts, and that does not count against. It's really wage income that takes a chunk out of your Social Security. So you're safe, and you can do this. And the math is really about an 11-year break even. So for every year you forego taking a payment, but then you have a higher payment the next year, in about 11 years, you've now made up for what you didn't take. That's the deal. We all know that Social Security appreciates. The payment goes up by about 7% per year. So if you were to be taking Social Security, now you've taken less because you've taken it earlier, and you're making 7 or 8% a year, then you are somewhat just breaking even, provided you live into your mid to late 70s. So it's a little bit of a wash, but here's where I would really consider doing it, Jamie, is that if almost everything you have is retirement money, and then you've got your pension, and you don't have a whole lot of after-tax money that you can get to in a tax-efficient way, then I would say that I would lean towards saying, sure, start building, take social so you can save it, build up your after-tax cushion, because you may need it from a tax perspective and a spending perspective one day.
Okay. Jay in Florida says, this is not an advertisement, just a review from a so far happy customer. Robinhood has rolled out some tantalizing incentives to draw people into their ecosystem, and it's worked
tantalizing.
on me. Mm-hmm.
Does she work for the Robinhood marketing team? Tantalizing.
Jay,
incentives.
I'm not sure. It also,
Jay,
yeah, it's
sorry.
a he. It's okay. For $50 a year, I have Robinhood Gold, which gives me an additional 3% on deposits into their IRA up to the yearly max contributions. It also provides Morningstar insights and a full-service brokerage platform for advanced charting, which I use. Finally, it allowed me to sign up for their credit card, which gives 3% cash back on every purchase. Some of the redemption options are gimmicky, making the clear-cut best option for my earned points to just dump them directly into my brokerage or into my IRA. With our charge volume yearly, this is a substantial amount of found money that I can use to boost my investment earnings. What do you think?
Jay, all right, man. I think that, and I've looked at you guys. You guys are the credit card experts.
We reviewed this card a year ago. Yeah.
Christa is and Clark. They're the Clark team. Are credit card.
We have
experts.
someone who just researches this, but at the same time, we always say every single article we write or anything about working the credit card game, you have to be someone who pays your balances off in full every month if you can do that.
If you're late a day or two, they just make it all back, because this particular card is it's almost 30%, I think.
Oh, it's
insane.
insane.
It's like 28,
yeah.
29, 30% APR. So it's crazy interest if you're just a day late.
But not for everyone to use credit cards for sure.
Here's some of the math here. You get a 3% contribution up to your max. So that'd be, let's call it $7K in the 401 IRA. That's $210. So you get a free $210. It's only $50 for the card. So you're getting $160 a year. That's pretty good. The second thing is that 3% cash back on every purchase it can be a big deal. I mean, 30 grand a year in spending, you're paying it all back. It's $900. Now, so you're to the good here about $1,000 a year, and that's not nothing. Now, they can always make changes. I mean, this reminds me of the toasters of the 50s. Remember, banks would give you a toaster if you opened up an account at a bank. This is just a modern version of a toaster, except it's a pretty nice toaster.
Yeah. For now, for sure. I mean, they started it, I think, in 2024.
It seems like it's still going. And Jay says it's tantalizing because it is. More than anything, we're talking about a serious thing here, and that's your investments. That's really what matters here. This is not a checking account. It's not a utility that you could it's the same at any bank. Robinhood, if you like the platform, the charting, and it makes it easier for you to be the best investor you can be, then that's really what matters. So you're not flipping over to Robinhood just because of these incentives to take a lesser platform. And I'm not saying it is at all, but what matters is that you really like the platform and it makes it easy for you to be a great investor over time. In addition to that, these rewards, as long as you're paying your credit card balances off immediately or with zero down late time, then you can really use this to your advantage, Jay, and it's not a small amount of money.
Okay. All right. We're going to take a quick break, and when we come back, you're going to tell us the key to a winning 401k.
Yes, ma'am.
Winning.
Welcome back to Ask an Advisor. Wes Moss here, along with Christa DiBiase.
Yep.
Christa, the key to a winning 401k. What is it?
Winning. By the way, I use that word because of Charlie Sheen, because I watched a Charlie Sheen documentary on Netflix after I heard him interviewed on my favorite podcast I listen to, which is not a financial podcast. It is called Armchair Expert.
Yeah.
And with Dax Shepard and Monica Padman, it's a really, really great, I love that podcast. Anyway, Charlie Sheen has done this documentary, and it's
he
about
did
his
it about
life.
himself.
Yeah.
Okay.
And I mean, I assume that, I don't know if he came up with it with somebody else or somebody wanted to do it on him, but it's been a crazy life and it was very interesting. And he's sober now, and I hope he stays that way because he really.
Does he seem, now that he's sober, is he a lot, he doesn't seem like he's bouncing off the walls. Does he seem pretty normal, or is he still a little out there?
He did. No, and what I saw, he did for sure. I mean, he recognizes that, things went off the rails a lot for him, and, I don't know. I'm rooting for him.
The last thing I remember about
sure.
him was Tiger Blood. That was when he was talking about winning. And
yeah.
Well, maybe he is now that he's clean and sober.
I hope so.
God bless him.
Especially for his kids. Yeah.
Well, here's the key to a winning 401k.
Okay, let's hear it.
And this is an article that I found this week, and that was the title of it. It was the key to winning 401k. And I said, wait a minute, what is the key? Of course, I think I know the key, but. And the key is, and this is for anybody who is, let's say, younger in our audience. And the reason I like this story is because I've seen this happen just over and over and over and over again. This was what happens in real life. And there's two people they mention, and these are just fictional characters, but you can relate to them. It's Laura and it's RJ. And Laura and RJ are both 25, and they both make $75K a year, and they both have a 401k. And we're going to talk about what they end up by the time they're in retirement or by the time they hit age 60. And they approach it not that differently, but it's a really big end result difference. So Laura jumps in day one. She goes to the HR meeting. They say, you really should be saving in your 401k. So she says, boom, I'm done. I'm in 10% of my salary. And the company gives a 3% match. So she's saving 13%. Not bad for somebody who's just out of school.
I'm trying to get my daughter to do right now.
RJ, on the other hand, he knows he needs to do it, but he's 25, and he's saying everything's expensive, and I'm like, I'd like to have a little bit of fun, and that seems like a lot of money, so I'm not going to start right away. So he waits 5 years. Then he goes back to that same meeting when he's 30, and he says, the HR person is right. I should contribute. So he finally does. Only 5 years later, he's 30. It's still young, and he contributes 6%. Enough to get the 3% match. Mm-hmm. And the 3% plus the 6 gets him to 9%. Not bad. Not a huge difference here on paper. Laura's at 13%, Charlie Sheen. RJ is at 9%. Started only 5 years later. But that little gap, that small gap, ends up being a really big part of the whole story. Now, in fairness, RJ's, and we're assuming now that private equity comes into the equation, and maybe these private equity firms or the investment options work, and he chooses a target date fund that has some exposure there, and he gets a really nice rate of return. He gets 8.9% average rate of return over time. But Laura chooses something a little more traditional, no private equity, and again, this is all hypothetical. She does okay. She does actually pretty well too, but it's a 0.5% difference per year. She makes 8.4% per year. By the time they're both 65, both had climbed the career ladder. They're now making about 180 grand a year. So they went from 75 to 180. Again, I've seen this story over and over again in real life. What is the difference between their balances? The question. Laura has over $3 million when she's 65. RJ, who got a better rate of return, only started 5 years later and saved about 4% less per year. He's at about $2 million. It's over a $1 million difference. So those little variables that just don't seem like they're that important when you're 25, 28, 29, they may not seem like a big deal, but they are a big deal. 4% more doesn't sound like a lot, but it really adds up. 5 years late doesn't sound like a lot, but it really adds up. Even in this case, RJ's rate of return was better. Laura still ended up with over $1 million more. So that to me is just this is a very real life story. This happens probably every day in America. This is happening. And I think it's important for you to be aware of that, because that extra time and a little extra savings can be a big deal in 25 or 30 years.
I'm going to send that clip to my daughter. Although she believes in savings. She's had a Roth IRA for a long time. But, when you're starting your first job and you're living in an incredibly expensive city, which she is, it's really hard to make that leap, because she wasn't eligible yet for her 401k. So, and do a Roth, which her mom is encouraging.
And do a Roth.
David in Oklahoma wrote in with this. Wes and Christa, I really enjoy Ask an Advisor. Thank you very much. We are grateful for you listening, David. I'm a certified registered nurse anesthesiologist, CRNA. I'm currently a W-2 employee making close to $300,000 with typical benefits and a typical retirement contributions from my employer. They put in 9% and I save close to 8%. As a CRNA, we have opportunities to work 1099 and open an LLC or S Corp. There are currently jobs close to me that pay $330,000 on a 1099, though I'd probably make closer to $370,000. I'm a married father of 4, with one of them about to start college in 2026, and my wife's a stay-at-home mom. Is it worth it to go 1099 for some more freedom of investing and saving a higher amount? If I paid myself a salary, what is a good amount to pay myself?
David in Oklahoma, that's a pretty awesome career.
Oh my gosh,
the CRNA, my godson is studying to do that same thing, because it's a huge amount of income, and there is a fair amount of flexibility. So it's a super career. And if I'm just doing the numbers here, David, you're at $300K, you're contributing 8%, so that's 24 grand, let's say, approximately. And then they're giving you 9. That's, I think, maybe part of the key to the answer here is the 9% is another 27,000. That is a contribution from the company. That's a big number. So you're at about 50 grand, call it $51,000. That's a big deal. Now, to your point, you could go out as a 1099 CRNA and probably make, you said
350 to 370.
Let's just say 350. And you do the same math here. So you max out, and you have your own plan. Now you're your own boss at this point. You're 1099, so you set up a solo 401k. And yes, you can save more if you do that, because you get to do your employer contribution. The employee side of it is the max, the 23.5. Actually, next year the IRS just came out with new numbers. They upped it to 24.5. But let's just say it's 24 grand, and your 25% of your net adjusted income gets you to another 58. You're at about $70,000 a year. So you're able to save more. You're at 70 as a solo 1099. You're at 50 as an employee. So that's not nothing. It's $20,000 more. But at the same time, you're also giving up $27 worth of free money that the employer is giving you.
That's a huge 9%.
That's a really big number.
I wonder if health insurance is part of the benefits too.
I'm sure it is. So you're
for
going
a family with 4 kids,
you're going to pay for your own health care as well. The other thought here is, so that's big deal, is health care is not going to get covered anymore. Some of your life insurance or disability insurance, that's probably not going to get covered. You've got no more paid time off. I think about it liability-wise, right? If you're solo And I know there's ways to get in these group plans with malpractice, or I believe there are, but that's a little bit scary too in the world we live in. This is there's some liability risk out there, particularly for this profession, really almost any medical profession. And then you've got to start paying your own taxes. You've got to have probably a tighter relationship with the CPA, and then you've got the administrative overhead. I'm a big advocate to get out there on your own, own your own business, but really what you're doing here is you're just opening yourself up to more complication, more liability. I don't know if it's worth it in my book. It is definitely more money. And there's a little bit more savings, but I somewhat think it's not worth the jump in a pretty high risk field. And that's, so I don't have a perfect answer for you, but I think if it were me weighing it, you're in a really good spot, and I'd probably be staying at that really good spot.
Okay. Juan in California says, I've been lucky to be a Silicon Valley high earner. My prior employer of 4 years offered a Mega Backdoor Roth, and I was able to max out 401k contributions every year at around $69K a year, 401k plus the match plus the Mega Backdoor Roth. I started work at a new company, and they do not offer the Mega Roth. And additionally, an employer match is a pitiful $2,000. This limits me to a measly $25K in contributions. I know there's a backdoor Roth, but it's capped at $7,000, and then there's the pro rata rule complexity.
Yeah.
I'm going from saving $69,000 a year to just $25,000. What other tax advantage retirement options do I have? Otherwise, my plan is to put all that money into a diversified ETF like VTI using a personal brokerage account that somehow doesn't sound very safe, relatively speaking, and there's also zero tax advantage. What can this quote-unquote poor Silicon Valley brat do?
Juan, you're not a poor Silicon Valley brat. I think you're a Clarkie, and you're wanting to save a bunch of money into a Roth, and that just makes a lot of sense to be able to do that. So I would, first of all, I'd double check your new 401k. If you can do after tax contributions, but you still can't do the Mega Backdoor Roth, you still may be able to make this thing work. If you are allowed to do the after-tax contributions, then you do your regular contribution, and then you go above that, and you do let's call it up to 70, starting next year in 2025, approximately. And then the next step would be, does the plan, and a lot of plans do this, Juan, allow for an in-service distribution. So if you're able to have the after-tax contribution and they allow you to do in-service withdrawals, then you could essentially have your own do-it-yourself Mega Backdoor Roth, DIY, MBDR. It's possible, but it doesn't sound like that's gonna work. So we'll say, you can still do your regular backdoor Roth conversions on the IRA side, but you're leaning against that. So you're right. You're going from saving almost 70 down to 20, mid-20s, and the answer here is that you can still save money. It's just after-tax money, and that can be. It's not quite as good as a Roth because it doesn't get to grow tax-free like the Roth does. But there's a lot of flexibility when you have an after-tax account. Low-cost ETFs, super high tax efficiency, and then you can then manage your withdrawals when you get into retirement. It's almost as good, but not quite. But that may be the only thing you are able to do.
All right. And Ben in Georgia says, my wife is considered a highly compensated employee at her company. Based on this, she's limited to how much she can contribute to her 401k. So the company has what's called a restoration plan as an option for her as a non-qualified deferred compensation plan.
And non-qualified deferred comp. Yep. Okay.
My question is generally, what are the pros and cons of this kind of plan? She currently makes a little over $250,000 a year, plus about $80,000 in bonuses. 11% of her paycheck goes into the restoration plan, and 6% goes to her 401k. From what I can see on the restoration plan, when she retires in about 10 years, she'll have the option to withdraw from that in equal payments for either 5, 10, or 15 years. I'm concerned about how we will handle those payments in the early years of retirement from a tax standpoint, as that will be considered income. Just a little more background. I'm turning 50 in 2026. Yay, catch-up contributions. I make about $90K a year and max out my 401k with about 50% in a regular 401k and 50% in a Roth 401k, as well as max out my Roth IRA every year. My wife just turned 47 and also maxes out her Roth IRA in addition to the 401k and restoration plan mentioned earlier. We also contribute $500 a month to a taxable brokerage account. I love listening to the show.
He says that she contributes to a Roth or a Roth 401k?
She does, let's see, my wife just turned 47. She maxed out her Roth IRA in addition to the 401k restoration. Yeah, I was surprised she could do a Roth IRA.
They make like $420,000 a year.
Yeah.
Huh. I don't know if that's that squares, but okay, keep going.
Oh, just Ben wrote at the end, I love listening to the show. My commute into work every week. Thanks. Thank you, Ben.
Ben, I love you listening to the show,
yes,
man.
we do.
I appreciate it. Here's the thought is that there are pros and cons to all these things. The restoration plan that I've seen this in, I don't know how many companies in America have something like this, but I probably know where he's working, and I know what the restoration plan is all about. It's a big company here in Georgia, but look, there's not a lot of drawbacks. One drawback is that it's non-qualified, so it doesn't have ERISA protection. Mm-hmm. It's not protected from a bankruptcy situation or a creditor situation, and the company has to be able to make good on it. So that's a little bit of a worry, but I'm not worried about it here in this situation. That you can't roll the money over to an IRA. That's obviously a little bit of a drawback. And then they mandate you on how you want to take it over time. So there's a little lack of control there. But it gives on the plus side, you get more savings above the 401k cap. You still get tax deferred growth. The company can do crediting, and a lot of companies do a good job with this. So you get a pretty nice rate of return. And they don't have to give it to you, but historically, I've seen companies that use these restoration type plans usually do a pretty good job at how much they're giving you in percentage rate of return every year. So it really turns out to be a serious asset. It could be worth $300,000, $400,000, $500,000 by the time your wife retires. So all of that good outweighs the negatives or any sort of drawback. And then the one big question then is that how do you take it? And you're right. It could be a big tax burden if you choose the 5-year option. If it's $500,000, you get and you choose the 5-year option, it's $100,000 in income every year, and that's probably not a good idea. The good news is you can take it over 10 years or you can take it over 15. So you can really spread that out. So if you think about $500,000 divided by 15 years, now you're talking about $35,000 a year. So it's a way lower tax burden for you. And I think you will know, Ben, you and your wife, when you get to that early retirement age, 62 or so, my experience in helping families plan for this in very similar situations, you'll know how you want to spread it out when you're getting closer to retirement. If you're going to take Social Security at 62, then you may want to be limiting how much you are pulling out from the restoration, and you maybe choose the 15-year option. But if you're saying, you know what, I really want to wait till I'm 70, but I'm going to stop working in my early 60s, and you need a little bit of extra income to bridge the gap to get to 70 and have that higher payment, great. Then you maybe take the 5 or the 10-year option, and you get a little bit more every year from that restoration plan. But you'll know in the year or two leading up to when you really want to stop working what the right option is as far as the amount of years you choose to receive your restoration. You guys are doing awesome.
Great. Well, that is going to do it for us this week on Ask an Advisor. And I'm sorry about last week us not having an episode, but we took off for Thanksgiving for the week. And we will be back next week with a fresh episode for you. I also want to say happy birthday to my son today.
Happy birthday.
He's a December 2nd baby. Everyone, I hope you have a wonderful rest of your day. Thank you so much for being with us.